What I'm going to be presenting today is due diligence in investment crowdfunding. I am the current vice president of product at KingsCrowd, where we focus on ratings and analytics and helping retail investors invest in startups online through investment crowdfunding. Now, due diligence is a huge topic. We are really just going to be kind of touching the tip of the iceberg here, but hopefully what I will present today is enough of a framework and to give you an understanding to be able to get started. Now, everyone, depending on your investment goals, depending on how much you're investing, depending on the type of companies that you're investing in, is going to have different things that they do as part of due diligence. But I'm hoping that by sharing my own personal experience and some of the lessons learned along the way, that it gives you a place to get started. And at the end, actually stick around until the end. I have a link to be able to download my own checklist that I actually use on my own investments when I'm making investment crowdfunding investments. So if you stick around to the end, I'll share that. And hopefully that will be enough to get everyone started. So an overview of what we're going to be covering today. What is due diligence? Why it's important? How much time should you be spending doing due diligence? And we'll kind of talk about some different studies that actually looked at potential investment returns based on time spent doing due diligence. We'll look at some quick comparisons just in terms of as a crowdfunding investor in the crowdfunding regulation A space. How does that due diligence differ from angel investor or traditional venture capital due diligence? We'll talk a little bit and dive into some studies that look at intuition, kind of gut assessments versus analysis, which is more of a checklist approach, and which of those may actually be more appropriate or not for you. We'll take a quick look at the funding portal and broker dealers' roles within the due diligence framework. I will then present my personal framework that I use. I've sort of taken this and tweaked it and made it my own. But again, it's called the 5 T's framework, which is something I've come up with. Place to get started. So I will share that. We'll talk about due diligence resources for all crowdfunding investors. And then at the end, again, stick around so that you can download that free checklist. So what is due diligence? For anyone who's bought a used car before, right? You've probably gone to a lot, looked around, tried some different cars, doing some test driving, kicking the tires, so to speak, opening up the hood, right? You're trying to figure out which of these is a good potential car that sort of meets your requirements for what you're looking for. Maybe that's just getting you from point A to point B, but for another person who wants to have a race car, do drag races on the weekend, they have maybe very different requirements for what that car is that they're looking at. Now, similarly, for anyone who has bought a home before, you have gone probably toward multiple open houses. You need to get the home inspector involved so they can look under the floorboards and behind the walls and how's the roof in terms of condition. Both of these are different examples of due diligence. Essentially, due diligence is making sure that you're getting at least what you paid for and hopefully more than what you paid for, especially in the case of making an investment. So one definition that I personally like in terms of due diligence is from the Angel Capital Education Foundation. They say that the primary objective of due diligence is to mitigate investment risk by gaining an understanding of a company and its business, as well as determining the suitability of the investment for the portfolio. So if we break that down, there's kind of the 3 different areas. First is mitigating investment risk. So you're looking at things such as what is the potential for fraud in this offering? As with anything that attracts capital and money, there are going to be potential people who may be looking to take advantage of that situation, and there may be the potential for fraud. Also, are the founders being honest? Are they realistic? What do I think the biggest obstacles are? Do they have the right skill set on this team, the right experience, and the right judgment? These are some of the different areas that go into mitigating investment risk, kind of removing some of those potential areas of concern for why an investment might fail. Then it's gaining an understanding of a company and its actual business. So do you understand how they make money? What's the business model? What's the potential market and the potential upside? Do they have any traction today? What's the growth, competition, differentiation? What's the defensibility? All of these things come into play when you're trying to gain an understanding of a company and its business potential. And third, very importantly, is determining the suitability of that investment for your own portfolio. So you as an investor are going to have your own goals, your own objectives that you're trying to do. So does it match up in terms of valuation and stage? There are certain investors who prefer to invest in, just very early stages when it's a couple founders in a garage, right, coming up with an idea. There's other people who prefer to be more later stage when a business is maybe de-risked a little bit more mature. Do the founder's goals align with your own goals? So if they're looking to build a business and maybe flip it or sell it in a few years versus building a long-term sustainable business, maybe even becoming a unicorn, kind of two very different outcomes. And has a place in different investors' portfolios. But the most important part is making sure that whatever you're investing in aligns with your goals for your portfolio. Now, there are many reasons why startups fail. This is a quick list of some of the top 10 reasons that were cited as startup failures from CB Insights. You can see here, no market need, ran out of cash, not the right team, pricing cost issues, whole bunch of different things. Now, the numbers here do add up to more than 100% because many businesses cite more than one of these as the reason that they failed. However, as Devin alluded to, I'm an aerospace engineer by background. And so my engineer training has taught me to look for root cause. And if you take a look at all of these things, you could apply something that I've used in my engineering degree and in my profession in the past, which is called the 5 whys. It's basically you keep asking why 5 times until you can't ask why anymore. Then you've gotten to the root cause. So let's take a look at ran out of cash. Why did you run out of cash? Had maybe too many employees. Why'd you have too many employees? Maybe you overhired. Why'd you overhire? Because you thought the markets were going to be better than they were. You can drill down. Same thing with outcompeted. Why'd you get outcompeted? Why didn't you change your strategy? What I think all of these actually boil down to is one thing, and that's the founder. Especially in the early stages of a company and its founding, so much relies on that founder or founding team, if it's multiple people, in terms of overcoming obstacles. If there's one thing that's consistent across, every early stage business, small business out there, there's going to be issues, right? Nothing is ever smooth sailing 100% through. And having a founder and a founding team that's able to navigate, pivot when needed, be able to deal with those and come up with scrappy ways of surviving is key to the success of a business and thus of your investment. So there's a quote here, kind of a polarizing person, Jason Calacanis, Silicon Valley investor, but in his book, Angel, he seems to agree. He says, the number one reason a startup fails is that the founder gives up. So one of my most important criteria when I'm looking at a deal, in addition to a lot of the other due diligence criteria we're going to discuss, is this founder someone who I think is going to win against all odds and take this to the end? Now, what I'm going to be discussing in terms of due diligence for my own framework is focused more on the kind of equity-based deals. However, I think a lot of these principles are also going to apply to small business investments, investments in debt and revenue share deals, some of the more main street businesses. But remember that a lot of the questions I'll be posing may not be applicable to that. So again, take some of the framework and the different criteria that I'm going to be sharing with you and tweak it for whatever your own investment process is. If you prefer to invest in those smaller local businesses, debt, revenue share deals, that type of thing, take what's applicable to you and you can discard the rest. So talk about due diligence. You could go in depth in so many different areas. It's such a wide spectrum from, the small crowdfunding investor writing a $100 check to private equity firms that, have leveraged buyouts of, hundreds of millions of dollars, right? Huge, huge, huge acquisitions. Now, due diligence is a spectrum that runs that whole gambit of different areas. So some of the different areas of due diligence, for example, within business, you might dig into the team, the market, customers, looking at suppliers and talking to partners, looking at company financials. When you get into the technical side of due diligence, looking at the technical solution, the product roadmap, what's their cybersecurity setup? There's legal and regulatory, compliance, intellectual property, patents, employment contracts, taxes, the legal entity of the business itself. This sounds like kind of a silly thing to look at, but we have actually heard anecdotally that there have been companies out there who've done Reg CF offerings that maybe weren't even actually registered as an actual entity in good standing with their state to be able to do so. So there's all these different areas of due diligence. And then on the investment due diligence side, portfolio alignment, as we already discussed, deal terms, what's the cap table look like if there's been past investors, market comps, and there's many more than all of this. Now, there's no expectation that as a crowdfunding investor, you're going to be able to be an expert in every single one of these and all the other plethora of areas out there. However, what we're going to be talking about is what's that right balance? How much time as a crowdfunding investor should you be spending to be able to expect reasonable investment returns? To help address that question, we're going to take a look at the impact of due diligence time versus angel returns to see if there's a correlation in terms of if you spend more time in due diligence, does it actually correlate with better investment outcomes? This was a study that was done in 2007 by Robert Wiltbank called Returns to Angel Investors in Groups. Now, the study covered a pretty small group, 538 angels across 3,000 investments, but at least starts to give us an indication of whether there is a correlation of time spent in due diligence versus investment outcomes. Now, you'll notice here that the median investment time for due diligence was 20 hours. This means that half of the people, half of these angel investors spent more than 20 hours, while half of them spent less than 20 hours. You'll even notice that roughly 1/4 of these investors actually spent more than 40 hours per deal doing due diligence. Now, when you take a look at this chart, some interesting things start to come out. First, what you'll notice is that the group with low diligence, that is the group that did fewer than 20 hours investments, is shown in red here. There was many, many more deals that returned less than 1x of the capital, which is essentially traditionally considered a failure. If you're not returning what you at least invested, you're getting cents on the dollar, if anything, back. Now, similarly, if you take a look at the difference between the red and the blue on the high end of the chart, these are the very positive outcomes, those home run returns of 10x to 30x or more. There was a very small number of the people, of the angels, who spent less than 20 hours actually had 10x plus returns, whereas there were more, relatively speaking, of the people who spent the high diligence, 20 plus hours a time, who had those positive outcomes. So as kind of cohorts, if you look at the group that spent less than 20 hours, they had a 1.1x overall return, basically breaking even for what they invested. If you take a look at the group that had the high due diligence, this is those who spent more than 20 hours, there was a 5.9x overall return. So Wiltbank's takeaway from this study was essentially that when it comes to due diligence time, more hours of due diligence positively relates to greater returns. That's great. I think, okay, we've kind of got that as a starting point, but does it make sense for a crowdfunding investor to spend 20 to 40 to 60 hours per deal? Well, let's take a quick look at some typical due diligence times and where it may shift between angel versus crowdfunding versus VC. Now, in general, due diligence time should tend to increase as the capital being committed increases. So this is to say, if you're writing bigger checks, you're going to be doing more due diligence. If you're writing a $100 check, don't get me wrong, that's a lot of money to a lot of people, but you're going to be having a certain expectation of that investment versus if you're writing a $100 million check, you better be doing your diligence and kind of all those little nitty-gritty areas to make sure that nothing's slipping through and you're mitigating risk. Now, in addition, you may increase due diligence time as the business goes from early to later stage. One, because you may be investing more capital, but two, there's probably more to do due diligence on, to be honest. If you're a company that's just started, you have no prior revenues or no customers, can't really do a lot of diligence versus a company that's been around for a few years. You have a few years of financials, you have customers to growth rates to look at. There's more that you can look at, which tends to come along with that higher valuation that they may command. Now, with angel investors, as we looked at, typical median time of 20 hours, from the one study, with some angels doing more around 40 to 60, but also some doing under 2, still writing potentially the same check sizes of $10,000, $25,000, $50,000 per deal. On the venture capital side, venture capitalists tend to invest more per deal, right? So where an angel investor's check size maybe 10K or 50K, venture capital, probably a couple 100,000 up to maybe a couple million. Now, venture capital firms range all the way from 24 to 48 hours, which actually Hustle Fund is a VC firm that's kind of famous for making a decision within 48 hours of seeing a company and getting the pitch. Ranging up to multiple weeks. So there was a study in 2016 where the average due diligence time for VC firms across, I think, about 900 different firms was 83 days, 83 calendar days, and 118 hours. Definitely more than the angel group. Now, private equity, you can think these are some of the groups who are coming in even later in terms of later stage, typically looking to get a business that's already pretty mature that has a lot to analyze, but then trying to optimize it. They will average 3 to 6 weeks over a couple different studies, but remember that they're involving much larger teams. There's a lot more in terms of merger and acquisition, M&A due diligence, and so it can sometimes run 6 months or longer for due diligence. Now, what about crowdfunding investors? We've kind of got all this in front of us. Where do crowdfunding investors fall within those different times, and what's reasonable? So to help address that question, there's a concept I've kind of come up with, I don't know if I've seen anywhere else, called return on time invested. So let's consider the difference between an angel investor and a crowdfunding investor. Let's take a high net worth, don't get me wrong, angel investor who say has $25 million to deploy. Typical allocation into startups and crowdfunding investments might be 10%. That's kind of a rule of thumb. So that'd be $2.5 million. Now, if you spread that across 50 investments to build a diversified portfolio, it's an average check size of $50,000 per investment. Okay. Now, from different various studies, IRRs, which is the internal rate of return, basically think of it as kind of a compounded growth rate that you might expect for your investment, tends to be 20, 25, 30%, for early stage investments. So let's assume a 27% IRR from one of these studies. Based on a $2.5 million startup portfolio, a 27% annual gain would be about $675,000 per year. Now, lastly, let's take total amount of time to build that portfolio, 20 hours over basically 50 startups, so that's 1,000 hours total. There's going to be additional deals that these people are diligencing that they also don't invest in. So this is even being conservative on the side of it would probably be more time than that. Let's assume they spent 1,000 hours. If you divide 1,000 into 675,000, they're effectively paying themselves $675 per hour. A lot of assumptions going into this. I understand this is not very precise by any stretch of the imagination, but it's a good approximation. Now, what does this look like for a crowdfunding investor? Let's assume crowdfunding investor has a net worth around $250,000. So a 10% allocation would be $25,000 into startups. And that would be about a $500 check size per deal if they're looking to build a diversified portfolio of about 50 startups. Now, that size portfolio at the same IRR would pay basically $6,700 per year. So if you're still spending 20 hours across 50 startups, it's 1,000 hours, you're effectively paying yourself $6.75 per hour. You got to ask yourself as a crowdfunding investor, is that worth it? The takeaway, for me at least, is unless you really enjoy the screening process, which don't get me wrong, people do. I may be one of those people. But spending 20 plus hours on every single deal of due diligence when you're investing a couple $100 per deal probably isn't worth your time. Compare that to probably what you're making at your job. We as crowdfunding investors are doing this part-time. We're not full-time, on this, doing it as a profession in most cases. And so you need to think, what is the right balance to strike? So the key question for you as crowdfunding investors is, assuming that Reg CF investors are writing these smaller checks, call it around $1,000 or less, and can't afford to spend 20 plus hours per deal, how can you optimize your due diligence? And can you still expect similar returns as angels? Let's look at some quick differences between traditional angel investors' due diligence and crowdfunding due diligence to help answer that question. Now, traditionally, angels, especially pre-COVID, would tend to have access to founders in person. So it wouldn't be unlikely for them to fly to meet the founder in person, to perhaps go out over a meal, try to get to know them as a person, get a tour of the business if there's a physical location. All these types of things made sense. Also, because angels tend to be writing larger checks in the 10,000, 20,000 plus range, they can afford to spend more time and more expenses vetting this. A $1,000 flight out of a $25,000 deal isn't as big of a percentage as if you're investing $100 per deal, that $1,000 flight is going to be a lot more. So traditionally, again, angels could expect more time, more access to founders in person because they're writing those larger checks because they have a larger size. Now, on the crowdfunding investor side, the access to founders is going to be more limited. It's typically restricted through funding portals. You still be able to ask questions via the Q&A page, but does not make sense for the founder. They don't have time to be able to sit down with thousands of potential investors, even for 1 hour meeting each, when you're only investing a couple $100 per deal. Just doesn't make sense from them, doesn't make sense for you. Now, because these crowdfunding investors are writing these smaller checks, again, call it that 100 to 1,000 per deal, it's going to be less efficient for you to spend in other areas, like the flights, like having meals with other people to get to know them, and doing that as part of your screening process. However, all is not lost. I would actually say and argue that there are many potential advantages that crowdfunding investors actually have over angels for these reasons. First is the power in numbers. That is to say, the wisdom of the crowd. Think about the traditional angel investor deals. most of those depended on angel networks traditionally. It could be syndicates that you're part of online, but even more likely, it's an in-person network of where you live, geographical, or who you know. Now, because of that, there were fewer people getting into these deals. And even if there's a deal that you would love to be able to invest in, you might not have access to that deal as a traditional angel. Now, the difference is because there's fewer people doing diligence on it, a lot of them maybe aren't sharing their diligence with others as well. Let's take crowdfunding on the other side of this coin. What happens is when one of these offerings gets posted to a campaign page, it's now open for everybody. There are thousands of potential investors who are looking at that opportunity, coming from all walks of life, all backgrounds. You may even have experts from that industry who are looking at the potential deal. So one of the huge benefits, in my opinion, that crowdfunding investors have is that all of these questions from that diverse potential investor base can be made public via the Q&A page. So you've essentially got a prepackaged, comprehensive, and concise due diligence package of questions coming from all of these different investors of different perspectives, asking that of the founder, seeing how the founder responds, and then also being able to learn from those investors. And maybe it's an industry that you're not an expert in, but by seeing what some of the people who are familiar with the industry or do know the right questions to ask, you will learn a lot. So that's one of the huge advantages. Second is personal relationships with the founders. Think about this. Many of the campaigns that launch online on these crowdfunding platforms tend to bring their own engaged communities with them. Now, because of that, many of these communities who are their customers today, they want to take and turn into their investors. But you have a pre-existing relationship with those people. So what do you think is better? Just trying to get to know a founder and who they are at their core over a 1-hour meal after you flew out to meet them, as an angel might? Or being on a newsletter list, having been engaged with this community and actually having seen how this founder and this team interacts with the community, how they execute for months, maybe even years before. So for that reason, personal relationships and just being personally involved can be another potential big leg up that actually crowdfunding investors have, where you have more perspective about that company, that team, how they execute, than an angel who might be coming in and just trying to assess something from out of the blue. Third is there are a lot of crowdsourcing due diligence services that are out there. So as Devin mentioned again, I'm from KingsCrowd, head of product at KingsCrowd. And what we do is a couple things to be able to help potential investors. First is we will actually sit down with many of the founders, do a 45-minute to 1-hour interview, either over email or sometimes over on a call, on a Zoom call, ask them some of the tough questions, and then take that interview, summarize it, and share it with the thousands of potential investors. What we've essentially done is made it a more scalable way for you to still get some of that angel investor type access, one-on-one, but doing it in a scalable way that works for the founder. In addition, we do deeper dives in terms of ratings and analyst reports, and we'll take additional information from more sources than just the offering page. We'll look at, LinkedIn, and we'll go through the market sizing and a whole bunch of other things, and then package it all up to be able to help investors make better informed decisions and make more efficient use of their time. And never forget that equal opportunities between both angel and crowdfunding investors is try the product. If it's a consumer product, if it's something that's out there, especially something that's free, try it out. See how the user experience is. Is it delightful to use? Is the founder and what they're sharing and that team on their campaign page actually matching up with reality? You can learn a lot from trying to use the product. Now, it's very important as well to understand that there are certain roles and checks that the Reg CF platforms, crowdfunding intermediaries, have to do as part of their own diligence for being able to host a deal. So traditionally, angel investors, venture capitalists, they're going to go and do legal and background checks and digging into probably a whole bunch of other things that maybe the average crowdfunding investor might not have the time or the knowledge to be able to dive into. But wanted to share real quick that some of the required areas that Reg CF intermediaries, which are the funding portals or the broker dealers, have to do are, for example, conducting background checks on the officers, directors, 20% equity holders, conduct bad actor checks on issuers as well as other participants, for example, certain promoters, being subject to anti-fraud, anti-manipulation provisions. So making sure that, from everything they can tell, that there's nothing fraudulent, that investors, there are no investor protection concerns or risks, and having a reasonable basis to believe that the issuer complies with Reg CF, disclosure requirements, et cetera, and has an established means to keep accurate records of your securities. So maybe they work with a transfer agent, that type of thing. Now, these are some of the bare minimums, right, that every platform, Reg CF platform has to do. So it's good to be aware of, but also be aware that some intermediaries may do additional due diligence above and beyond this. However, it's not a requirement by the regulations. Certain deal platforms rather may curate opportunities. And then if the platform is a broker dealer, they may also be subject to additional or stricter standards such as KYC, know your customer, AML, anti-money laundering, additional suitability standards if they want to make advice or recommendations, which is something only a broker dealer can do, but not a funding portal. So just be aware that there is more due diligence that the platform is also responsible for, but it kind of stops here. They're not necessarily looking to say, hey, this is a good or a bad investment opportunity necessarily, if it's a funding portal. They're really just trying to make sure that they are compliant with the bare minimum requirements of Reg CF. That's where you, as an investor, need to get more involved and do that additional due diligence. So what are your opportunities and different resources out there that you can use as a crowdfunding investor? Well, again, I think one of the huge advantages actually that Reg CF, Reg A, and online Reg D opportunities have is that you don't have to be constrained to a certain geographical location. You don't have to get on a plane and fly to the other side of the country anymore. You can do a lot of this due diligence from the comfort of your own home, watching Netflix or being in a coffee shop, that type of thing. So where do you go? Where do I go when I'm looking to do due diligence? First, the funding platforms themselves. Take a look at the campaign materials, right? Promotional videos, they'll have financials posted there. A lot of the info is essential and required, but very useful on the campaign materials. Now for Reg CF, offerings have to be done through the intermediary. So they have to point investors to there, which means they have to post all of the required materials that they need for that offering on that page. As I also discussed, the investor Q&A can be extremely valuable on these pages. This is something that, again, I think is often overlooked, but think of all the different investors from all the backgrounds that are asking questions, and it's all being compacted into a concise little package that you can quickly go through and take a look at. You can also learn a lot about the founders through this process. How are they responding to questions? They'll get asked some tough questions, and you can kind of tell the founders who snap and maybe have a little bit of a snappy or impatient response. Is that someone you really want to be investing in? It's up to every investor, but you can learn a lot from that process. Second is SEC, and actually going direct to the filing source of Edgar. This is not for everybody, totally understand that. But when a company files their Form C, which is for a Reg CF offering, and their 1A for a Reg A offering, they have to have certain disclosures filed with the SEC. This is the location where all those filings get made. There's also annual reports and a bunch of other good information you can find from the SEC database. In addition, as we've discussed, rating services and deal aggregation services like KingsCrowd make it easy to look across all the 80 plus platforms that are out there, look in one place, and do additional due diligence above that. Also want to give a huge shout out to CrowdCheck, fellow member of the board, Sarah Hanks, the founder and CEO of CrowdCheck, but team there is amazing. They have some fantastic due diligence resources, not only for investors and looking at potential deals, but for founders, for issuers, and for platforms who want to become funding portals. So highly, highly recommend checking out CrowdCheck. Also have a fantastic blog that really gets into a lot of the nitty-gritty details and the good to know things in terms of the nuances of the regulations. Again, use the app, the service, the product, whatever it is. If it's possible, you got to do that before you make an investment. You can learn a lot that way. You learn a lot about the team and how they've executed. You'll get updates, that type of thing. Furthermore, for my own kind of education, I don't mind mixing it in with entertainment every now and then. And there's a lot of good media out there. Shark Tank, The Pitch, which is a podcast, highly recommend. Inside Startup Investing, podcast put on by KingsCrowd, where we talk with a lot of founders. And then, some of the different platforms have their own podcasts and media shows. Meet the Drapers was for Republic. Adventure Capital is for WeFunded. There's a whole bunch of resources out there of really good resources that are also entertaining. And you can be learning at the same time as kind of enjoying yourself. And then online research. This isn't the 90s anymore where the internet was just becoming a thing. You can find out so much on the internet today. Crunchbase is one resource that you can go to do kind of business research, see who may be invested for past rounds. PitchBook is another one, very pricey, probably outside of the realm of possibilities for most crowdfunding investors, but a good opportunity and option definitely for VCs. There's resources like Statista that can give you market forecasts looking over, say, the next 5 to 10 years. Is this market going to be something that's big? Google, LinkedIn, definitely essential. Look at the founders, their networks. Do they put out content there? What's their following like? And of course, the website and social media accounts of the company themselves. This is just a sample graph, I pulled from Statista, I think for the equity crowdfunding industry, but just shows you kind of where it's at today, where they see it going, over the next 5 to 10 years. And you can use that with the rest of the information you gathered during due diligence to see if this is an opportunity that you want to invest in. So I think it would help to paint a picture if I actually just walk through kind of my deal funnel, my quick process at a high level, how much time I spend on each step. So the way I think of my deal funnel and when I'm looking and screening deals is there's the deal flow. So you kind of have to find some of the deals first that you want to take a look at. Then I do a level 1, kind of an initial screen, which is really looking for some high level criteria. Level 2 is like deeper due diligence, where I'm actually going to do some diving into the SEC filings and some of the other relevant materials. And then level 3 is actually making the investment decision. So when I start out, I have accounts on select funding platforms that I tend to invest in. There's 80 plus out there though, so it's really hard to go to each platform. So that's where you might use a deal aggregator like KingsCrowd to be able to go at one place and look across all the opportunities that are out there. Then what I tend to do myself is screen for high momentum deals. Now, this doesn't mean they have to have hit their max or getting close to their max, but I want to make sure that they've at least hit their minimum target. The reason for that is that I would hate to spend 5, 10, or 15 hours of time on a deal, even if it's very promising, but that never even reaches its minimum target and that was never even a viable opportunity to invest in. When a Reg CF campaign doesn't reach their target, all the funds get returned to investors. So it's kind of that minimum threshold. I wait for it to at least hit its minimum target. That also gives me some more information in terms of this team is able to attract some investment. They at least have some minimum level of salesmanship and interest in their product from outside investors and customers. So I then go to my level 0 kind of initial screen. I look at 2 big things. First are the deal terms. So personally, I tend to invest more in equity-based deals. So I can immediately kind of toss out a lot of the debt or rev share deals. And then in addition is the investment minimum below my threshold. So if I'm investing $200 per deal and the investment minimum on this deal is $1,000, doesn't make sense for me to do due diligence on that. I'm already out. So that's a very quick way to kind of segregate that amount of deals. And then the second thing I look for in kind of that initial screen is portfolio alignment. So again, personally, I have a certain risk versus return profile that I'm looking for in my own investment opportunities, but maybe you're an impact investor. You want to invest in environmental and social impact deals. You got to make sure that there's that alignment with your portfolio and your goals before you go doing any deeper diligence. So per deal, again, I'm not spending more than maybe 10 to 15 minutes in this part of the step. It's just that high level alignment check. Then I move into kind of the level 1, a little bit more of a detailed screen, but I'm going to take a look at, for me, the founder and the founding team, which is very important and crucial, for the reasons that I shared before, as well as the upside potential. So again, because of my investing style, I'm interested in more equity deals that may appreciate over time. You may be interested in more steady income and, lower risk opportunities or investing in Main Street business. Whatever it is, you got to check for that alignment in this step. And then I look for the team here. And in addition, this is where I use KingsCrowd definitely as part of my own process, where I'm looking at the ratings and the analyst report. I'm seeing if there was that founder profile so that I can get more inside of the head of the founding team and seeing if they're aligned with where I think the business is going. And then I use some other criteria that I'll be sharing on my level 1 checklist. So again, a little bit of a deeper dive, maybe 15 to 20 minutes for that step. Then if I decide, yep, hey, this is still something I'm really interested in, I think there's potential here, I'll do deeper due diligence. So now I'm going to be, digging into the campaign page. I'm going to be looking at deal terms. I'm going to open up the subscription agreement. I'm going to be making sure there's no big red flags. I'm going to be making sure that the deal is of interest and also a reasonable valuation. So because I'm investing in equity deals, this is where I'll really take a deep look at the valuation if I think it's reasonable or if it's maybe a little bit detached from reality. And other resources. I'll go a little bit broader, look at LinkedIn's of the team, especially the founders, do some Google researches. This is where I'll actually use the product. All those types of things basically roll up. If you sum all these deals, for each deal that I'm looking at, I'm probably spending about 2 to 3 hours before I make an investment decision. Now, 2 to 3 hours, if you go back to the angel study and the correlating the investment outcomes, that's on the lower end of things, right? So do we really think that this could result in positive investment outcomes? Well, one way I actually like to look at this is what's my effective time that I get through leverage on each of these steps? So let's jump down to level 1. When I'm using a tool like KingsCrowd, it could be CrowdCheck, it could be other investment services out there. Maybe I'm only spending 30 minutes of time looking at the package that has been put together, reading through the analysis. But in actuality, there's probably been 5 to 10 plus hours behind the scenes that have gone into all the conversations with the founder and digging into the details and actually summarizing that info into what the most important points are. So I credit myself 6 hours, for that step, but conservatively, I think that's honestly more for a lot of deals, especially that we do at KingsCrowd. And then when you go to the detailed due diligence step, again, if you assume we went to the campaign page, we looked at the Q&A, and let's assume there's 20 questions up there. Maybe each one of those questions, the person who asked it, had certain background, they'd already done their own research. Maybe they spent 30 minutes to an hour each. If you just multiply that out, that's at least 20 plus hours of due diligence, crowdsourced due diligence that you have there for your use that you can read and get pretty quickly. So all in all, I think my effective time, even though I'm actually spending 2 to 3 hours tangibly per deal, is more on the order of 25 to 30 hours per deal through those different forms of leverage. Because of that, that puts us more in that 20 plus hour bucket for the angel returns. Now, I'm going to be sharing this at the end too, but you can get this is just my personal screening checklist. This is kind of the questions that go through Brian's head when I'm thinking about if I'm going to invest in a deal. You can get it at kingscrowd.com/DD checklist. I'll also have a link at the end. But again, this is not the process that KingsCrowd uses. They go much more in depth in a lot of different areas. This is just the Brian process. If you're looking for a starting point with a checklist to be able to invest. Now, what are some of the most common due diligence mistakes that I hear and see out there? First is having a one-size-fits-all approach or assessment. So maybe you're not considering the stage of the business or other nuances with the investment criteria they're looking for. An early stage deal is not going to be the same and not have the same criteria as later growth stage deals or something that's about to go IPO. Very different areas, and you need to be looking at different things. So you can't come up with a cookie cutter approach or a single formula that you think you can apply across any investment, any deal out there and have it always come out, the same. So just keep that in mind. You need to really look at each of these on a case-by-case basis. Second, this is a mistake that I've made in the past, but thinking that just because it's a good business or a great technology, that automatically makes it a good investment. This is what's referred to or can be referred to as a halo effect bias, where essentially a proficiency or an expertise in one area, you may take that and translate it to another area where it doesn't really translate to. So having a positive area impact in one area shouldn't impact your judgment in other areas, but it can. An example here is you might have the best business in the world, but if that is priced at an outrageously high price, you're not going to get a good investment return. So even if that business is fantastic, you need to look at the deal terms that you're being offered. You need to make sure that you take all of it into account of determining if it's a good investment. Third, is extrapolating past success for what's required to succeed in the future. So I think of this as kind of, looking in the rearview mirror, but it's that saying, what got you here won't get you there. As companies grow and evolve and mature, there's different skill sets required, both different skills of the founder, of the team in general. The customers are going to be evolving throughout that time. So you can't look in the rearview mirror and just extrapolate that past success into the future. You got to think about, do they have the right skill set, the right strategy moving forward? And a few from Seraph Investor that I like for kind of due diligence mistakes is confusing likability or prior accomplishments with the competence needed to pull off the current task. Again, that's kind of going back to the what got you here won't get you there. Confusing early adopter excitement with true market pull. And the issue comes down to a simple realization that an A team with a B plan will outperform a B team with an A plan every time. I believe in this. This is going back to kind of that key where, the team, the founder is really crucial, especially when you're just getting started. They're the glue that holds everything together. Last mistake, I made this myself, but we saw it a lot in 2020 and 2021. Don't rush the process. FOMO, or fear of missing out, is very real. You will, especially when getting started in investing, you will read some of these campaign pages and you will be so excited to get started. You'll feel like you have to do this right now and you need to give them all your money. Don't do it. Be patient, take your time. There's always going to be more opportunities. And if anything, a measured and trying to be more patient approach is probably going to result in better results in the long term. Now, one big question and a big point of contention with both VCs and angels, and will definitely come up with crowdfunding investors, is it better to invest based on your gut or using logic? So you need to ask yourself, do I want to rely on intuition, first impressions, kind of that, Malcolm Gladwell Blink impression of this was my initial impression, I'm going to go with that? Or would it be better if I'm more methodical, if I follow a checklist, have processes in place? Just remember, some angels may invest after a 1 hour meeting with the founder, whereas some of those others are taking 40 to 60 plus hours, and VCs are taking months. So it's a good question to pose. Is human instinct superior to using objective criteria? To take a quick look at this, we're going to look at two studies. The first is a Rice University basketball study where they looked at shots to determine how good is people's intuition versus using a methodical approach in judging the difficulty of shots. Outcome of this study was basically, it's okay to trust your gut, but only if you're an expert. My question would be, how would you know if you're an expert or not? Second is an airplane pilot approach. This was a study done by Jeffrey Smart as part of his PhD dissertation, where he looked at venture capital firms and how they evaluate management and leadership, called human capital valuation, and whether a checklist approach is superior or not to other approaches. So with this basketball study by Rice University, it was a 2012 study looking based on intuition. And basically what they did is they took some participants and assigned them into two groups. There was the intuitive gut feel group, and there was the analytical group that used checklists. Now, the analytical group, prior to the study getting started, was given a little bit of time so they could come up with some objective criteria of what would make a difficult basketball shot. Maybe it's distance from the hoop, how many defenders were around them, that type of thing. Now, the intuitive group did not have any criteria, didn't put any forethought into it. They basically just watched some videos and they had to judge basically how difficult a shot was. In addition, all these participants were assigned as either being an expert or a novice. This was based on actual basketball experience, playtime, not just watching videos. And then they all had to judge the difficulty of the various basketball shots. What did the results show? Well, intuition, perhaps unsurprisingly, was more effective for the experts. That is to say, if you were an expert, you had probably a lot of that experience already, going with your intuition in terms of whether it was difficult or not shot was a pretty good approach. However, where it gets interesting is the analytical group, both experts and novices performed equally. What's more interesting is that even looking at the analytical group, even the novices in the analytical group performed as well as, if not better, than the experts in the intuition group. So, looked at a different second study for this, where participants were again using intuition versus analysis to try and identify a counterfeit Coach handbag. Again, this outcome of that study showed that objective criteria unanimously equalize the results between the experts and the novices. So if you take a look at this quick chart down here, you can see on the analytical approach, think of that as kind of the checklist, having criteria, novice and experts performing equally in terms of high performance, whereas on the intuitive side, experts had higher performance, but novices had lower performance. My question to you, even if you believe yourself to be an expert, don't you think you'd probably be better off using a checklist or an analytical approach to your investing? Let's take another look at checklists and analytical approaches. So in terms of preventing human error, I'm going to ask you a question. What do you think airline pilots and surgeons have in common? Well, we could agree that both are very highly skilled professions. These are some of the top people in their fields, and they have very high risk consequences of those decisions that they make, right? One little bad mistake that a surgeon makes, or especially an airline pilot, may put one or more people's lives at risk. Well, something they have in common is that despite their very high levels of practice and expertise, both of these professions heavily rely on checklists to reduce human error. Now, there's a great book that goes into a lot more detail, gives many more examples by Atul Gawande called The Checklist Manifesto. I recommend checking that out. But it showed that these and many other examples, checklists unanimously improved outcomes across diverse fields, even among experts. Now, oftentimes, there's a lot of pushback from experts. You may be talking to a VC and recommend a checklist, and they could be offended, right? How can you boil down my complex job and all these things that I do into a checklist? Or, it's just going to slow me down, or it's process. Well, yes, there are bad checklists out there. But as demonstrated, through both the use of surgeons and airline pilots, there's so many variables that go into just all the decisions that humans have to make in today's world. Take an airline pilot. How many hours did they sleep last night? Did they have a fight with someone in their home, their household before they left? What's the weather going to be like today? What airports are they going to? So many variables that having this checklist, even for experts, is going to reduce human error and improve performance. And again, I pose a question. Knowing that even highly skilled surgeons and airline pilots use checklists, why wouldn't you want to use a checklist in your own investing? So let's take a look at the second study very quick, but valuing the founder and the team. So again, personally, I believe the founder and the team is often one of the most crucial aspects for an early stage investor to assess, especially when getting started. The glue, they are the glue that holds the team together, that's executing on the mission, that's pivoting, that makes sure that they want this to win no matter what. Well, we've also shown that checklists improve outcomes, even for experts. So let's see if that actually plays out in practice in terms of VC firms. Jeffrey Smart, someone who did a PhD dissertation, and took a look at something called human capital valuation. So essentially what he did is he took different VC personas from a group of VCs who are willing participants and gave them a different persona. He kind of categorized them in different areas based on how they looked and assessed the management and leadership team for startup investments. One of the personas he called the airline captain, which is that methodical checklist approach, returned an average IRR for their funds and for their investments of 80%. Now, another one of these personas called the infiltrator did have a positive outcome, but it was very, very, very labor intensive. This is basically the persona where you're going to become one of them. You're going to be on the team. You're going to be working with them every single day. And from a time management perspective, if you're kind of doing that to assess the team and then work with a team, kind of skews the results. So how did the rest perform? Well, all of the others were worst practices, achieved average IRRs under 30%. Compare that to the 80% achieved by the airline captain or checklist approach. So what were some of these other ones? Art critic, again, this is the gut feel. You look at something and after a few seconds, you think you have a good feeling for it. Sponge, which is similar to an art critic, but wants a little more info. The prosecutor, where you're basically as a VC or an investor trying to extract info from the management team. There's the suitor, which is rather than the management team trying to convince you, you're trying to woo the management team into getting you to be able to invest. And the terminator, which is kind of that, we're going to do this, but there's no saving the team. We're going to take you, fire you all, and rehire. So key takeaway, right, from my opinion, is no matter how much expertise you have or think you have in a given area, a well-designed, that's a key, well-designed checklist can improve outcomes. So hopefully I've convinced you that having a methodical approach to your investing and your due diligence process is useful. But as we showed at the start, there's so many different areas where you could dig in and do due diligence. So what makes sense for a crowdfunding investor? I'm going to introduce what I refer and use as the 5T framework. I've taken this and adapted it from a few different things, but this is what I found that works for me. And again, hopefully it's a starting point and a framework that you can use, but take this and adapt it to your own process and your own investments, and you will see how things kind of change and evolve over time. So at the core of the 5T framework for me is the team. And again, this is kind of just an easy way of remembering 5Ts are kind of like the 5 areas that I check off in my mind when I'm looking at any investment opportunity. There's the tech, which is the problem, the solution that they're solving. The TAM, which I just use as a T for basically representing the market. Traction, which also kind of represents financials and performance. And then the terms, what are the deal terms you're investing in? So this is my 5T framework. Each of those starts with a T. But again, team, founders being at the core of that. So for early stage startups, right, Brian's opinion, if the team, the founder isn't absolutely amazing, if it's not someone you would want to work for, that is someone who's going to see this through, little else matters. We'll dive more into that in a few minutes. Consider a symphony orchestra. You have some of the world-class best musicians on each of their instruments. However, without a conductor to be able to harmonize all of that and bring them all together, it would just be a cacophony of disjointed noises. And if someone goes off beat, and then you need the conductor, right, to be able to harmonize all of that and have a symphony orchestra be what it is. In a similar way, I think the founder of an early stage startup is much like that conductor of the symphony orchestra. They are the magic. They are the glue that pulls all the different things together. And when there are road bumps or something kind of goes a little bit off plan, they're able to pull everyone back together and keep things moving. For that reason, team, we'll spend a little bit more time on this, is, again, from my perspective, one of the most important areas to assess, especially when looking at kind of the early stage. For me, it's the only non-negotiable, pass, fail. And so if the team's a fail, you got to stop. It's hard to make up for a weak founder. However, if a founder is truly amazing, it can make up for weaknesses in other areas. So because of this, founders with successful past exits may command higher valuations. Now, we saw when we looked at different studies, investor exits and outcomes for founders were more positive when those founders had past successful exits, when they had industry experience, and just a fact, but 90% of unicorn CEOs in various studies had a bachelor's degree or higher. Obviously, this is not something that works for the Bill Gates, the Mark Zuckerbergs of the world, But statistically speaking, if you're looking to invest in a potential unicorn, most of those founders had bachelor's degree or higher. There was no positive correlation when you took a look at the team if the founders had past failures, so they really had to have successes, or founders with past startup experience, but as a non-founder. So it was crucial that they were not only a founder of the startup, but that they had a past exit. Now, again, correlation, not causation. It's always going to be exceptions. These are guidelines and heuristics. Wouldn't have worked for Mark Zuckerberg, Bill Gates, Steve Jobs. But those are more the exception than the rule. So keeping all of this in mind, we're taking a look at the team. I'm going to skip this. I know we're coming up to the end here, so I just want to make sure I can kind of get through each of these questions, and I'll show some of the sample checklist items for each thing. And then I will provide the link so that you can download the checklist and actually take a look for yourself. What I do for each of the different 5T areas is I kind of boil it down to 2 high-level questions, and then I have a checklist item list that I go more into detail on. So for the team and for the founders, kind of 2 high-level questions I ask are, is this founder, 1, absolutely amazing? And 2, do they want to win against all odds? So I'm not going to go through all of these, but is this someone I'd work for? Do they move fast? Can they sell both to investors, to customers, to employees? Do they have that experience? These are some of the questions that go through my mind when I'm looking at assessing the team. Second is the tech, which is kind of the product, the solution. T made for a nice transition there, but ask, is this product or service, 1, solving a real problem? And 2, is it at least 10x better than what's available today? So diving more into detail, you might look at, is it a capital efficient or capital intensive business? Is it a feature, a product, or a company? Do they have high product velocity, which means how fast they can iterate and ship product? These are all the types of questions that I'll look at when I'm assessing the tech or the product, the solution of a business. Third is the TAM, which is the market, and ask yourself, 1, is it both huge, and 2, attainable? Some of the questions we'll dig into: who are the customers? What's the business model? Is it business to business to consumer, direct to consumer? Can they scale it? What's the go-to-market? These are the types of questions that I go through. 4, traction and also financial performance. I ask, 1, is there a proven need for this product? And 2, are customers actually willing to pay for the solution? That's an important point because there might be a strong need, but if they don't pull out their wallet and pay, it's hard to build a business. So some of the questions I ask: what are the sales like? Letters of intent. Again, this depends on the stage of the business and where they are. Look at CAC and LTV, which is customer acquisition cost, lifetime value, burn rate, cash, debt, all very important in assessing the traction and financials. Lastly, terms. So are the deal terms suitable for my investment portfolio? And do they align investors and founders' goals? Taxes, I'll just highlight that here. Very important consideration. I think it gets overlooked a lot of the time, but think about any potential tax implications when you're starting out. All right, so we'll wrap up here because I know we only have 2 minutes left anyway, so this is perfect. But as a recap, 5T's framework, again, this is what I personally use. This doesn't necessarily work for every type of investment or every investor, but take this as a starting point, tweak it, make it your own. Team, tech, is it solving a real problem? TAM, which is the market, traction and financials, and the terms. So let's do a recap. We've talked about today what due diligence is, why it's important, why it's essential as a de-risking step, and also making sure there's alignment before you invest. In early stage startups, I've shown at least my opinion of why team is one of the most important points to look at. It can be a single point of failure. Thinking about that quote, an A team with a B plan will outperform a B team with an A plan every time. 3 is even for experts, experts checklists improve outcomes. And again, according to studies, this even holds true for human capital valuation, and again, makes novices kind of at that same level as experts. 4, the only constant in this world is change. So even if you develop a checklist, even if you have a formula that works, you're going to have to evolve that over time. Due diligence has to evolve. You have to evolve your processes. And 5, always understand what, if any, due diligence is being performed by the crowdfunding portals themselves. So thank you very much for your time today. I'll open it up for a few minutes of quick questions, but I'll just throw this up here where if you want to download my checklist with some of the sample questions that I asked that I showed here, you can download it at this link.